Hey guys, John Polemy here, Actionable Intelligence. And today I want to go over a lesson on overvaluations. And this is going to use as the test case what happened with Sun Microsystems. And the reason, this was during the tech bubble. And the reason I want to go over this is because we are in unprecedented, nearly unprecedented times of overvaluation in the US stock market. And I don't think that a lot of retail investors or new investors or people that are investing, they think they're investing in these stocks, understand what can happen or what the data shows us and what history shows us. I think what happens in many cases is people want to make money, they want to invest. That's a good thing, but there's a way to do it the correct way. And what we have happening nowadays is with the ubiquitous trading platforms like Robinhood and some of the other easy low commission or no commission sites that people can trade stocks, it makes it very easy to do. And so what typically happens is somebody hears a story or a narrative and they say, well, that makes sense to me, or that sounds good. And they buy it. They buy the stock. And if it goes up, then they confuse being at the right place at the right time or luck with being an investor. And that's not investing. That's just that's gambling. That's not even speculating. And I think a lot of people are confusing a bull market that has been, in my view, enabled by historically low interest rates and a lot of liquidity created by central banks. They're confusing that tailwind with some type of investing ability, and that's not investing. When you're investing, you're buying a piece of a business. You are part owner. You are a shareholder in the business. That is what you are. That is what you're doing. So when you're investing in the stock market, you are a buyer of businesses. Now that is different than speculating. Speculating is different. We won't get into that in this video. But when you are buying a business, valuation matters. And I talked about this in a video that I recently did for the weekly market update, but I wanted to elaborate more in this video and give you the specific example and then get into what you have to understand about overvaluation and what that means for forward returns. Okay, so I've showed this chart before. If you've watched my videos, you've probably seen it in the last couple of weeks. Basically, what you're seeing here is the total market cap of stocks with price to sales that are greater than 20 times. And what you will note is that if you go back to the tech bubble back here, this first rocket ride here, I don't know if you were involved in the markets then, if you read any of the history of what was going on. You know, we didn't have Twitter, we didn't have a lot of social media. We had Yahoo message boards, GeoCities, that kind of stuff. It was all primitive, the communication, but it still did happen. And so the hype machine was not as great as it is now. We didn't have Reddit and Discord channels and all this stuff. And so what we had here was $3.6 trillion in stock market cap of various stocks that were trading at price to sales ratios of 20 times sales or higher. And so that was obviously a bubble. We can look back in history. We know it popped. We know why it popped. We can look at what happened when it did pop. We can see that typically, you know, the market acts rationally for the most part, and we get these periods of unbridled overvaluation and this euphoria, and it's a new era. It's the same kind of talk you hear in every bubble. There's always going to be people that will be able to justify or tell a story of why these valuations are not overvalued. You're seeing that with this ARK investment with this Kathy Woods, I believe her name is. If you listen to some of her if you listen to some of her videos, I mean, she can spin a pretty good yarn. And if you don't know history, if you don't know about how to price a business, if you don't know that what is overvalued and undervalued, you can spin a yarn. You can tell about, how the new future of electric cars and batteries, and extrapolate linearly, and it's never ending, euphoria and unicorns, Skittles, puppy dogs, and little girls with pigtails. You can get sucked into that if you don't know history. And guys, that has happened to me before. Okay. When I was seeing this going on in the 1999, 2000, I had already learned my lesson, and I knew this was a bubble, and you would be shocked at what you would see. And you would be seeing everybody on one side of the canoe, and you and a couple other guys are on the other side. And the vitriol that you would get for just pointing out things like, this is unprecedented. This is, in the past, has not led to, positive returns longer term. Investing in companies that don't really have any cash flow or earnings is not a good, recipe. And then you would be called names. People would threaten to murder you, all kinds of things. And so then you're really in a bubble. And so you see what happened. Eventually, these things do correct for whatever reason. In hindsight, we can always tell what popped the bubble, or you'll have academics or people come on and say, oh yeah, everybody should have been able to tell it was a bubble. But if you're in the middle of it, if you're caught up in the euphoria, if you are uninitiated and without portfolio, you do not have the ability to be rational about these things. It's very easy to get sucked in. And so we come to where we are here. Now, when I put this chart up in the weekly video, you're always going to get people that come on. And so the first thing that someone said was, well, the market cap of the market overall is larger. So does that justify overpaying even 4.5 trillion? So even if the market cap of the market is double or triple what it was back then, this still doesn't make sense. People are paying $4.5 trillion in market cap. They're overpaying for stocks that are at 20 times sales. Okay. We're not even getting into what are the cash flow yields. I think somebody did a cash flow analysis of Apple, and its current market cap or price, I mean, the cash flow yield is like 1 or 2%. It's a good company. They've done well. I use an iPhone. I think it's great, but that doesn't mean it's going to be a good investment going forward. It has been a tremendous investment, but at some point things become overvalued. It's, it may be worth, paying $500,000 for an Italian sports car like a Ferrari or something, but it's not, paying $500,000 for a 10-year-old Volkswagen Jetta doesn't make sense. And so everything is relative, and people don't look at these things. So regardless, we've seen this before. We've seen this kind of euphoria before. And I would suggest to you that, could this go higher? Absolutely. Could this double or triple? Anything's possible. The future is unknowable to any of us. But what I can tell you is that we have data, we have people that have back tested things, and we can look at what is probable. Even though we don't know for certain what's going to happen, the whole premise of investing and speculating is to try to figure out what is the most probable outcome. And when the odds tilt to your favor and the probabilities are severely into your favor, that is when you invest. Buying things at 20 times sales with the idea that, the problem is that when you buy a company that's so overvalued, a lot of the expectations are already baked into the price. And so how do you exceed that? How do you go to 40 times sales? I mean, it's, and even a lot of these companies are in development. So I make this akin to, this kind of segues into a sidebar discussion, but, this kind of goes into, I do a lot of angel investing. And what I'm doing is I'm investing in companies that are at the seed stage or at the very early stage of their life. They have an idea, or they have a minimum viable product that they are trying to market. And maybe they're getting some traction, they need capital. And so when I go into this type of investing, my idea is I'm looking for companies that are going to disrupt a current large market, or something that's going to take pain points away for a lot of people. But I also know that if I get into 10 deals, 8 of them are going to go bankrupt. 8 of them are going to go away. I know that going in. That's why when you do angel investing, you don't just buy one, you don't get involved in just one deal. You get into 10, 20, 30, 40, 50, you build up kind of like an orchard, right? You plant trees and that you figure are going to produce, over time. It takes time for these companies to mature. But we know going in when we're an angel investor, how risky it is that 8 out of 10 are just going to go away, or maybe even more, sometimes 9 out of 10. And maybe that, 8 out of 10 go bankrupt, 1 does mediocre, and then you have the 1 that goes a moonshot. And it's usually one that you don't even anticipate doing that. And so what I'm telling you is we know that going in, but how many people know when they're buying these overvalued companies, what the situation is? Can they name the CEO? Do they know the products? What analysis is going into this? These are usually the kind of companies that have met, everybody is watching them. Everybody's got their money in. What edge does the average retail investor have in these things? So you're just riding, like surfing, you're just riding the wave. And that's fine if you're a momentum guy and you know when to get off and you're following these things and you're trading by a real rule book, but we're not traders. I'm not a trader. I'm an investor / speculator. And so we see what has happened in the past. This is very dangerous. Now, what I will tell you is this is more research. This is from Barron's, and I showed this chart also. This is the forward return on stocks with price to sales multiples greater than 15 times. Now, we already showed you that we have $4.5 trillion of market cap in the US stock market where sales are greater than 20 or 20 times. So we're just talking about this data set, which is, price to sales multiples greater than 15 times. And you can see that in the long term, you don't make money. And the reason why is, like I said, most of the expectations have already, that these tremendous hyped up expectations are already in the stock. Everybody's in it. What more better news can come along to push the stock up higher? So this is 50 years of data. And so again, if we're talking about probabilities, you can get sucked up in the hype and say, well, I don't care about the probabilities. If you want to draw to a gut shot straight in poker, yeah, you can get it. You can catch a card. It happens, but you're going to lose money you play that hand 1,000 times, you're going to lose money. And so the one time when you get lucky and hit it, that doesn't mean that that's how it should be played. That's the point I'm trying to make. The probabilities when you overpay are not in your favor. That's the point I'm trying to make. Now, most people, the holding period we know for the average holding period for most retail investors nowadays is a year or less. And we're not even, talking this far out. So most people aren't even investing and they're not even speculating at this point. They're just gambling. So that works fine as long as the overall market's going up. As a market, a rising tide lifts all boats, right? And when the wind comes along, a big wind comes along, even turkeys can fly. I mean, these are little quips, but they are reality. And so you have to differentiate the fact of, what the probabilities are. And if you're really, on the right side of history, or if you're just gambling, because if you're overpaying for companies, long-term, you're not going to be successful outcomes. And so this is this is what I wanted to get to, Sun Microsystems. During the tech bubble in 1999, 2000, this guy, Scott McNeely, was the CEO of Sun Microsystems. It was another company that was making like workstations and computer products. And they were doing very good. They were on a big growth track. It was a tremendous company. I don't even know if it exists anymore, to tell you the truth, or it got taken over by another company. And when the stock was trading at near its all-time high, which I'll show you the chart on the next slide, he knew it was overvalued. He warned people. He was talking about his own stock of his own company. And this is what he said. This is when he was talking about his company trading at 10 times revenue. Remember, we have $4.5 trillion of stocks trading at 20 times revenue. And here's what he said. At 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. Listen to what he's saying. At 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. Well, we know that's impossible. He's going to explain why. He goes on to say, that assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue rate. Now, having done that, would any of you like to buy my stock at $64 a share? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? And this is what happened. He gave this speech around this time, and the stock re-rated. The stock did not perform. It was overvalued. It had nothing to do, I don't know the prospects of the company. I can show you chart after chart after chart from when the bubble burst. They all pretty much look like this because things were overvalued. It did not really matter. Even top companies that still exist today, like Microsoft and Cisco, it took years for the earnings and cash flow to catch up with the inflated market caps. The stocks basically went down. They went down in the initial drawdown of the tech bubble crash, and then they just went sideways for a decade. Are you telling me you're going to wait around for a decade? No one's going to do that. And so if you overpay, this is what can happen. It feels good until it doesn't. If you want to draw to gut shot straights, you can. You'll get lucky occasionally, but if you play that hand 1,000 times, you will lose. So what you pay is important. How much a company cash flows is important. Why not figure out what the cash flow of the company is relative to the market cap and figure out what the cash flow yield is? Because that's what you are entitled to as a shareholder, is a portion of that. If you want to be an angel investor or a speculative investor, that's different. Or not even an investor, it's called a speculator or a gambler, that's different. If you want to mess around your phone on the bus ride to work because your brother-in-law gave you a tip about this company doing this and it has, and the stock goes up and you make money, that's fine. You're going to hit once in a while. You will not make money. You will not make consistent returns over the years. It's not possible. It won't happen. And so I'm trying to introduce you into the way of investing and how successful long-term investors that are successful, they don't overpay. And so what's the moral of the story? Stock should be valued at the present value of all future cash flows. Free cash flow of a company, since that is what can be returned to investors as dividends. While revenue is obviously a key driver of that, the bottom line is more important, and ultimately free cash flows and not revenue is what matters. But I can tell you that when you overpay, you have tremendous stock trading on hype based on just increasing sales with no free cash flow and no prospect of cash flow or earnings or any return to shareholders besides just an increasing stock price. You are gambling on gut shot straights. An important safety tip here. What you pay for that real or projected cash flow stream matters. Again, we showed you the chart. If you overpay, your returns long-term are going to be negative. Again, history shows that in most cases, when you overpay, your returns will be subpar. So what do we want to do? We want to seek undervalued securities and sell overvalued securities. We want to seek out and buy undervalued securities and sell overvalued securities. Now, most retail investors don't even know how to value securities properly. And so before you start trying to be an investor, if you want to gamble and be a speculator and get dopamine releases and hit the little thing on Robinhood and then the confetti goes up or whatever, how it works, I'm not on there. And it's more like a video game. That's fine. But don't put real money in the market under those circumstances. If you are trying to get a return, if you are trying to be a successful over the decades long-term investor, then there's a methodology that works because we have seen, success leaves clues. Buffett, Munger, Howard Marks, Stan Druckenmiller, Sam Zell. Study these people. They don't buy overvalued securities. Look for situations where the story is going from terrible to less terrible. Seek out stories, right? And then if the thing is, a management change, where or a company comes out of bankruptcy and they've restructured their debt and the management's changed and they have a new way of doing business and they're maximizing cash flow. We're seeing that all over the energy industry now, up and down. The focus away from drill baby drill to focusing on free cash flow generation and paying down debt and returning capital to shareholders. And what have we seen? Well, we've seen the commodity prices for hydrocarbons go up, and now those companies have set themselves up to go from terrible to less terrible, and the stock prices are rising. That's what I'm talking about. So I will put this, there's a white paper that Meb Faber wrote talking about real comp or returns versus valuation. And this is one of the charts for the United States stock market. Real compound returns versus 10-year cyclically adjusted PE ratios. This is from 1881 to 2011. Now, the data only goes up to 2011, and I don't have the ability to run the previous 10 years. Now, we've been in unprecedented times for like the last, decade or so because of the unprecedented amount of money printing that the Federal Reserve central banks have done, which is not going to be able to continue forever. And so what we see here is that 100 years of data, or more than 100 years of data, 140 years of data, 30 years, is that here's the PEs down here. So if you can buy stocks, the cheaper you can buy them, the better your 10-year compounded returns are going to be. If you overpay, we're in this zone now in the US stock market. We're in the 30 to 40 on the cyclically adjusted PE. I think it's 35 or something. And if you get it, you're not going to make money. And it's not like, 10 years goes by and you just like sit there and nothing happens. What usually happens is one of the years of the 10, you'll have a huge drawdown of 50% or something in the market. And then you have stagnant returns. And that's how you end up over 10 years with, zero returns or slightly less than zero returns. And I can guarantee you, if you're buying those overvalued stocks and you see a 50 or 60% decline in the stock market, most people will sell. They'll sell at the bottom. So they'll compound their initial mistake with a further mistake. And so I will put a link to this white paper. You can check it out. You should read it, because what I try to do is seek out markets, whether they're in the US or not, or individuals, industries, or specific stocks that are trading, that are undervalued or have, overlooked or are cheap. And it's not as sexy. It's not the big dopamine release when, you have a big run in a company like Tesla and they're launching rockets and these, Johnny Swift running around, going to go to Mars, and the dopamine release, and you're feeling like you're part of something bigger than yourself. It's all about probabilities. And I can tell you that companies that don't cash flow, have free cash flow or earnings, at some point they get valued for what their true value is. It's just a matter of time. And I would suggest to you that eventually the tailwind of central bank liquidity is going to come to an end at some point. And then, as Warren Buffett says, when the tide goes out, we're going to see who's been swimming naked. And so I'll put a link to this white paper. I suggest you read it. There's plenty of markets around the world that are extremely cheap, that are trading for, in this range here, these very, very low PE ratios. And there's stocks that are trading and so if you are an investor, that's where you want to play. And there's plenty of places where you can go to do that, where the big institutions aren't operating because it's not scalable for them. It's too small of a market, or too small of a market cap of a company, or whatever. And these things do exist. And you'll be amazed that, if you set your expectations correctly to what's realistic, of what you can really do. You know, Warren Buffett has said many times that if he wasn't running Berkshire Hathaway, if he was running a very small portfolio, say 50 million market cap portfolio, he could easily do 50 to 100% returns a year. And it's true, because there are situations out there, you know, the fat pitches that come across that you won't believe if you focus on undervalued securities that are at an inflection point and that are undervalued and are going to get re-rated. That's the kiddie pool you want to play in. That's your advantage. So I wanted to go over this with you guys because I'm trying to help people to be successful, to set expectations correctly, to show you that success leaves clues, and that other people that have used the stock market and bought businesses and are long-term investors, that the turtle wins the race, not the hare. And this is how it's done. So this is a short video to try to discuss some of those concepts. I hope you found it valuable, and we'll try to keep doing some of these educational segments as they come along. Thanks for your attention, and we'll talk to you next time.